Hello guys, let's see a problem B, which is problem of position sizing. Now this problem has a relation with your account risk. It is not, we are not here speaking about stop loss. We are speaking about the whole account risk, which is different from stop loss. If you don't divide your account principal to few parts, you will make your account very volatile and risky. Now what does it mean? It means if you put all your money into one trade, you have more risk than if you divide your money into many positions. I will explain. Here is an example. You have an account of $100,000. It could be 10,000, could be 20,000 or 30,000 or 5,000. Okay? The account should be whatever is your account. You bought a stock with your money. Then the next day you got a gap down and you lost 30% of your money. Let's say you have $100,000. You go, for example, and buy Twitter, or you buy Apple or Facebook, and then the next day earning date, and you lose 30%. What is this loss? This loss is 30% of your money, which is $30,000 is gone. Understand that. Okay, so this is what we call position sizing. You should never buy with all your money one stock. Your risk is too much. Okay, now, so how can you avoid that and make your account less risky and more safe? Now understand, I say more safe and I don't say safe. Okay, because there is no an account that it is safe. All the accounts have risks, but there are less risky and more safe than risky and that you can't change. So here is the solution. The solution is to divide your account into many positions. It means many positions, it means many parts, 2 or 3 or 4 or 5. Let's say you have 5 positions. Each position is $20,000. Here we are speaking with the same account. Okay, let's say $100,000. You divide by 5, you have 20,000 for each position. It means if you want to buy a stock, you buy with 20,000, whatever shares. Okay, 200 shares, 500 shares, 1,000 shares. It means it's the same thing. You buy only 20,000. You don't add to this money. Okay. And let's say you buy Facebook with $20,000 and then you have a gap up and you lose 30% of your money. Now when you see 30% of the 20,000 is only 6,000. Okay? So here is the deal. Although you can't avoid the gap down, because you can't avoid it, okay? Try to be logic. You buy a stock, next day it goes down. With a gap down, you lose a lot, so you can't avoid it. It means you can't stop that. But the thing is here is when you buy only 20,000, you have saved 24,000 from your whole account instead of buying the whole. Because here you become greedy. You think that your stock will have a gap up, and then you can make 30% or 20% or 40%, which is a good money. Yes, I understand this, but understand that a good trader is always looking to protect his account, okay, more than to make a big profit. Understand that. So you lose only $6,000, although you have a gap up, the same here and the same here. It's the same gap up, but the money is different. Here you bet with all your money into one stock, and here you bet with 1 out of 5 parts. It means $20,000, and you lose only $6,000. Okay, this technique, okay, let's see here, will save you a lot of money and make your account safer than using one position each time you trade. Okay, try to do that in your account and you will see that your risk will be minimized. Okay, you have less risk than trading with all your money. Even if you have only $5,000, you can put it like two positions, like 2,500, or you can put it like 4 positions. It means you divide as you like. Okay, but don't try to put all your money in one trade. Thank you very much, and go to problem C.